Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Dietrich, and I'm joined by my co-host, Sonu Varghese. Each week, we dive into the important market-moving events and cut through the noise to help you, as an investor, identify what really matters. Let's get this show started. And away we go. Welcome to the fourth edition of Facts versus Feelings with Ryan and Sonu. Sonu, you are in a hotel room as we do this, just in case your audio quality isn't quite as good as mine. Where in the world are you?
Yeah, I asked myself that. It's 6 o'clock. It's 7 o'clock in the morning. See, I've lost track of time. I'm in California, in Sonoma Valley. Last week we talked about wines and all of that, and here I am in wine country, and not drinking wine. I should tell you.
If anyone remembers our discussion last week, yes, you are allergic to wine, so let's avoid it. But
it sounds like you and I both.
Things to
right?
talk about. Mm-hmm. Yeah, well, I think I'm allergic just because I have too much, and then I wake up a little on the tired side. We'll leave it at that. But nonetheless, I don't really drink wine. Maybe once a year, and there's a reason I don't drink wine. But let's get into it, Sonu. There's a ton of stuff. We've had a lot of people reach out to us that are enjoying this brand new podcast series we're doing here at Carson Group, and we're going to keep doing it. We're going to keep doing it weekly, and it's going to be a lot of fun. This one we said would be a theme. Kind of a theme about what's going on out there. We're going to call it, make sure I have it here, the good, the bad, and the ugly. All right. There's some different things out there, but we're going to start with the ugly.
Let's just like the movie
stuff second or at the end.
I think the movie started with ugly, right?
You seen that? I've never seen that movie.
No way.
I think
it did. I think it did. Actually. Party for you?
So. Yeah, I need to see the movie, but I've heard about it. But let's start with the ugly. I mean, let's get serious for a second here, though. Obviously, the devastation that took place in southwestern Florida and all along the coast. Thoughts go out to him as someone who grew up going to Sanibel Island. My parents had a condominium, no more. They sold it, but it was let's see if I can remember it. 44 seashells of Sanibel on Gulf Boulevard there, and just what's happened to Sanibel and the different parts of our country down there, just devastating. And we're thinking of everybody, just really, really sad. So that's no question, that's ugly. And again, our thoughts go out to everybody down there. But let's turn to the market now. The ugly. I'll just set the stage, Sonu, and bring you in here. This was the third worst start to a year ever for equities. If you look at the S&P 500, down almost 25%. Only 2002 and 1974, going back to World War II, actually were a worse start to the year. We're going to get into some of the better things that could happen from that. I'll just give you this. Those 2 years bottomed within the first week of October, or the first 10 days of October, I should say, in 1974 and then in 2002. Both of those times marked major lows in the bear market. Both of those times saw the fourth quarter gain, this is kind of interesting, 7.9%. Now, the time you and I are recording this, we had a big day on Monday, a big bounce so far on Tuesday. Sonu, so what do you think was the this is a loaded question. What's the reason stocks have had such a terrible year so far? So far is the key concept. We think there could be a good bounce, but so far.
I think it comes back to the Fed. I feel like we keep talking about this week after week, and there's no avoiding it, right? You've heard of the phrase, but don't fight the Fed. And so I was curious about that. Wait, where did that phrase come from? And it turns out it was Marty Zweig in 1970 who coined the phrase "Don't fight the Fed." Right? I mean, hindsight's 2020, but and it seems like beginning of the year, Ryan, if I told you Fed's going to raise rates to by 300 basis points at 3%, and there's more to come. We're not done with the year. What would you have said? Like, would stocks go up or down, right?
Yeah, let's rephrase. Let's rephrase that. On January 1st, if you would have said the Fed would hike rates 300% and the Cincinnati Bengals would have made the Super Bowl on January 1, I don't think anybody would have believed you on either front. But Here we are, right? Here we are. Yeah, I would have assumed we'd probably have a rough market, right? I don't quite think we'd be down this much if you told me the economy is still hanging in there. And we'll get to the economy here soon. But again, it is what it is, and that's definitely one of the ugly. One of the other ugly things, just over the weekend, Credit Suisse was rumored to be potentially falling apart, or on the verge of bankruptcy or on the verge of a lot of trouble, kind of the first Bear Stearns or Lehman Brothers type of thing. But first things first, you call it Credit Suisse or Credit Swiss? What do you call it, Sonu?
I think I
I've heard
say
both.
I don't know what you should call it. I call it Credit Suisse, but
Right.
as long
Well,
as
it is
everyone
the second
understands
largest
who we are
bank in
talking about.
Switzerland. So, yeah, I think Credit Suisse also, because it's in Switzerland. But nonetheless, what is your take? Because over the weekend, it was all over Twitter. This is the first big one to fall because they didn't anticipate rates going this high. It is what it is. Major bank in potential trouble. And by the time you hear this podcast, maybe there could be more trouble going. But the market kind of shook it off the last 2 days at least. What do you think? Is this the first domino, kind of like a Lehman Brothers?
Look, when markets are, really down, as you talked about, it seems like everybody comes out of the woodwork saying, "Oh, this is the big next shoe to drop. There's some crisis there. There's some crisis here," and we've had enough.
Right.
I'm not saying, we haven't had some of that, especially with the UK, a week or two ago, and it's never a good thing when a banker hits the CEO of a bank hits reply all and tells everyone in his organization, "We are fine." And then if they have to make calls to everyone they work with saying, "We are fine," that is never a good thing, right? If you have to convince people you're working with, if you're a bank, saying, "Oh, we're okay. We have enough capital. We're not going to go bust," right? They probably don't say that. But everyone starts to get, wait a minute, why are they even doing this? Right. So I think that's what happened over the weekend.
Yeah,
and, it doesn't take much for the Reddit crowd to come and jump on something.
No, absolutely. And let's be honest, after the year we've had, there could be some trouble. In 1994, the last time the Fed hiked rates aggressively, similar to this year, although this year is even more aggressive, and I think it was around November, December, Orange County blew up, right? They had the big Orange County because they didn't factor in all those rate hikes. So the likelihood that all these hikes and the surge in the dollar, we're probably going to have some trouble. Now, here's the way to look at it. Once you have that trouble, that could be maybe that chance that potentially the Fed turns a little bit more dovish. As we woke up this morning, the Bank of Australia hiked rates only, quote unquote, only 25 basis points versus 50. We talked last week about the Bank of England buying 20-year treasuries, long-term treasuries, becoming maybe a little more dovish. So listen, those are some things that, clearly we're paying attention to. We're not minimizing it. The other one, this isn't really a joke, although some people think it's funny. Kim Kardashian's paying over $1 million fine for promoting some cryptocurrencies. All right. When you see people go away in handcuffs, when you see more fines coming in, historically, anecdotally, that almost means you are closer to a potential bottom than the top, right? Because people are mad about something, and rightfully so. So those are just some anecdotal things. We'll talk about sentiment, which is actually one of the good things out there, in a little bit. But that's something that's happening. But clearly, that's potentially very ugly if the second largest bank in Switzerland were to really get in trouble. The third thing that's ugly, 60-40 portfolios. We've talked about it, I think, every week now. Stocks and bonds have had a really rough year. Second worst year ever for a 60-40 portfolio. Only 2008 was worse. Sonu, talk to me about 60-40 and what your thinking is.
Well, we've talked about the 60 part of it, stocks, right? And I think to a certain extent, everyone's invested in stocks, expect, okay, there's going to be volatility. That's why we put stocks, for the long run, literally, right? As Professor Siegel, Jeremy Siegel has written the books about. Yeah. It's the 40 part that's really hurt, right? No, everyone expects the 40 to zig when the 60 is zagging. And that's the idea, right? That's the protection, right? But it hasn't happened this year, right? Like bonds have had, like you said, worst year since it's like a 15% drawdown from peak to trough, including last year, this year, the Fed's raised hikes. It's funny if you think of, going back to don't fight the Fed, right? It's usually related to stocks, right? Don't fight the Fed. Now it seems like don't fight the Fed and get out of bonds, right? No, I'm not saying get out of bonds, right? But it seems like that was a message earlier in the year, or that would have served one well if you didn't have bonds in your portfolio. But it's really, the rates have gone up. That's it, right? And when interest rates go up, the prices of bonds go down, right? I think that's been the struggle for 60-40.
And let's be honest, it's what's priced in, what's not priced in. Like we talked about, I think last week, but in June 2021, the Fed thought there'd be like half a hike this year, okay? Like one hike in 2023. Right. It's those expectations that caught everyone off guard. Every time the Fed seems like they open their mouth, by the Fed, I should say, Jerome Powell, comes off a little bit more hawkish And that's why we've had these big sell-offs ever since Jackson Hole late last month. So anyway, so that's clearly ugly. Let's go to the bad. Now, here's something that's bad. My dog Thurman is 15 and a half years old. He's still hanging in there, but he cannot make it all night without having to go into the bathroom, which means my wife and I, like I have a baby, we alternate nights taking him outside. So anyway, this morning at like 5 a.m. Eastern time, I'm outside with Thurman. I'm starting to walk inside. We've got like a sidewalk or something. Anyway, long story short, I stubbed the you-know-what out of my big right toe. I fall on our sidewalk. I thought I broke my toe at 5 a.m. Or they're like, oh my God, I think I ripped my toenail off or something because it hurt so much.
In Cincinnati yet, right?
But no, it's not snowing. It's not snowing, but I'm seeing stars, put it that way. Anyway, so I look and my toe's okay. But as you and I are recording this is, I don't know, 5 hours later, my toe still hurts. I didn't break it, I didn't rip the toenail off, but man, did that hurt. So that was bad. I wouldn't call it ugly, but that was bad. But anyway, the other thing, let's go to what else is bad here. So Sonu, PCE, the Fed's favorite measure of inflation. I'll turn it over to you in about 1 second here. That came in, I think it was Friday, maybe Thursday or Friday. Higher than expected. Again, more inflation data, higher than expected. This is the one the Fed likes to use. Talk to me about PCE and why it's bad.
So PCE that's a personal consumption expenditure price index. I mean, if we get personal consumption data, this is built off of that. So the Fed, and we have several measures of inflation. We have CPI, which is a consumer price index, the PPI as well, the producer price index. So CPI is usually what, that comes out earlier in the month. That's usually where all the headlines are. PCE is important, is especially important, Ryan, as you said, with respect to the Fed. They like PCE because, both are baskets, right? Both are baskets of what people buy, right? Goods and services. Right. So the CPI basket is not updated, in terms of the mix of what's in the basket. It's not updated.
I got to jump in for a second. Sonu, give me 1 second. Sorry, I thought you said they're both bastards. I was like, wait a minute. Whoa, this is for children. I'm teasing. No, you said baskets. Go ahead. Sorry, it sounded like bastards.
We're in the bag.
They are kind of right. They feel like bastards. Inflation. Yeah.
All right.
It's bad. Sorry. We'll keep it PG from here on out. Yeah.
Yes. So the consumer price index is not the basket. The mix of the basket is not updated for about a couple of years or so, whereas the PCE index is continuously updated as people make decisions of like, oh, we're going to buy more goods instead of services, or we're going to buy more services now instead of goods. The mix changes, right? And so the price of the basket changes because of that, because that composition has changed. And PCE can also get revised. So that's partly why the Fed prefers it. It can go back in history and say, oh, wait, inflation is actually higher or lower over the last 2, 3, 4, 5 years. Right. So that's one reason, a couple of reasons why the Fed prefers the PCE price index to the CPI. Bad news is that PCE is too high, right? It was close to just under 6.5%, about 6.2% year over year. And really the story is, look, goods prices are not coming down fast enough, right? Ryan, you and I have talked about this in the past, including on the podcast with Varghese, right? You're not seeing apparel prices come down. You're not seeing furniture prices come down. You're not seeing used car prices come down. You're not seeing new cars prices come down. And every other indicator that tracks these things is saying, these prices should be coming down, but we are not seeing it in the official inflation data yet.
No, absolutely. I'll just say this. Look at some notes I had last week. The month over month on the PCE came in at 0.6% versus 0.4. So if you see that, you're like, whoa, that's a lot hotter. Now here, this is fun with numbers. The actual month over month came in at 0.56, so it rounds up. It was expected to be 0.44. So that runs down. We're not minimizing this higher number, but when you see that headline number, it maybe wasn't as bad as it seemed. But nonetheless, another data point that's showing inflation sticky. Now, this is bad, but maybe a little good. You've done some really good work, and I think a blog comes up today on Tuesday that you took a look at rents, and we are seeing some positive signs finally out of rents. Talk to me about that one.
Wow, yeah, this is, we could spend a whole hour talking about rents and what's happening with that. So rents
we would lose everyone that listens to this podcast. No one would listen. Don't talk about rents the whole time. That'd be boring.
I agree. So anyway, rents are a big part of the inflation basket. We're going to talk about the basket, right? So it's about 40% of, look, there's, in addition to headline inflation, there's the core inflation piece, right? Core inflation strips out food and energy because they're volatile, which is crazy to think because it seems like everything's been volatile this year, right, over the last year, whether used car prices, airfares, things like that. But anyway, rents are a big part of both indices. 40% of core CPI and about 20% of or so of core PCE, right? Now, if you look at most measures of rents, these are private measures of private indices, right? You have the like Apartment List and Zillow and CoreLogic. All of these guys measure rents and put the data out. Apartment List has shown a pretty big deceleration in rents, right? I think we've all probably heard anecdotes about rents going up. And so Apartment List data shows that rents were up 18% year over year back in November 2021, right? So it's a little under a year ago. The latest data for September shows that that's come all the way down to 7.5%. That's huge. You've gone from 18% year over year to 7.5%. The problem is CPI data, official inflation data, still shows that the rental inflation numbers are going up, right? And in a fairly quick way. And that's really what's contributing to high inflation right now, beyond, food, energy, all of that. So set that aside, right? Now, the problem is it comes down to how the official rental inflation numbers are measured, right? So rents are a big part of it, but most of us, I think about 60 to 70% of homes are actually owned. So what the government says is that if you own a home, we're not going to take home prices into the CPI, right? We know home prices have gone up, but those don't go into the official inflation data. Instead of that, they say, we're going to pretend as if you rent your home to yourself as a service, right? So how do they get the number for rents? They look at other equivalent units, right? Comparable units, and say, oh, a home like yours is renting for X dollars. So that's what it is. So it all ultimately comes down to rents. And the other thing is that the CPI, or the official inflation data, when they collect the data for rents, they have a massive sample of homes that they survey. Now, they survey these homes only once in 6 months, right? And so every month they have a rolling, set of homes they survey, but each home comes back into the sample, so to speak, once in 6 months. So if there's a big sudden spike in rents, CPI is not going to capture that, right? It's going to capture that only, with a lag. And we see this in the data because, again, going back to the private, like the Apartment List number, right? It hit a low of about, close to negative 2% back in July of 2020, whereas the official rental inflation numbers bottomed only 9 months later in April of 2021. So if you think about that, Apartment List, let's say, peaked November 2021. So you think maybe, official rental inflation data should maybe peak right about now. Maybe it goes up for the next month or two, but it should peak soon. That's the good news. The bad news there, coming back to the bad, is that it's going to take a while before the deceleration actually shows up. That may be, close to March, April of next year before we see these numbers really coming down. But again, going back to slightly positive stuff, look, there are a huge number of multifamily units under construction right now, the most since 1974. So we have a lot of supply coming in as well. I think that's positive,
All right. Now, good stuff there. So bottom line, rents could be improving by slowing down, yet the government's not even going to show it in the government's data for like another 9 months. So wrap your head around that. Very quickly, Sonu, with earnings, I mean, this is what we call as bad. We've seen some major companies, Nike, Carnival, some other big ones have had some disappointing things to say about what they expect earnings to be. This is earnings season coming up. We're going to talk a lot more about earnings season in the next couple of weeks, but there's likely going to be some downward guidance. The good news is we're right where we were at the start of the year, what earnings are expected. Earnings went up for the year. Now they're coming down. We'll talk a lot more about that, but that potentially could be a bad thing in terms of how many companies are lowering earnings guidance going forward. We've got a little bit of time left, so let's focus on the good. We've talked about the ugly and the bad. Potentially good is October. Hinted at this last week. October is historically a bear market killer. Just talked about in 74 and 2002, October made major lows for some vicious bear markets that kicked off pretty good rallies. 6 of the last 17 bear markets actually ended in the month of October. Clearly in a bear market now. We're down over 25% in this bear market. And, so clearly that's getting up there. But in a non-recessionary bear market, and you can't have those. We don't still think we're in a recession here. They bottom about 24% correction. So we're in that sweet spot. And I do have one other data piece here I worked on. So down 25% for this bear market. Only 6 previous bears have done that, going back to World War II. If you just buy the day you're down 25%, which was last Friday, they median bottom about 37 days later, so about a month later or so. And 1 year later, S&P's up a median of 26% on average once you're down 25%. Trust me, I use medians for a reason because averages are skewed by 2001 and 2008 and 73, 74. But if you don't have one of those rare, longer bear markets like we don't think we're going to have, we could be closer to a low. Sonu, I want to bring you in now for a second. What were my notes here? Let's see here. The economy. Employment still looks pretty good. We just saw with the lowest number in claims since late May. Talk to me about some good news on the economy, because there is a lot of bad news. What do you see positive out there?
So I'll take 3 things, right? One is we know the labor, employment's been fairly strong, and unemployment rate is around 3.7%. It ticked up last month, and this last month I'm talking about, the August data. We'll get September data soon. But the August data showed the unemployment rate going up from 3.5 to about 3.7. But that was because of a good reason. More people came back into the labor force to look for jobs. They don't do that amidst, if you are in recessionary conditions, right? And we've created about 3.5 million jobs. The economy's created 3.5 million jobs this year over the first 8 months. We're probably not going to be creating 500,000 jobs a month going forward. But even if it slows down to, say, 250 to 300,000, that's still very good, right? Then the other piece, as you mentioned, unemployment claims, right? So when someone gets laid off, they file for unemployment claims with the state, right? The state measures it, and all that's rolled up into the national numbers that we see. That's below 200,000. That's really low, right? And continuing claims, the number of people continuing to claim unemployment benefits, that's about 1.3 to 1.4 million. Before the crisis, we were running close to 1.8 million. This is really low. Which tells you that people are not laying off, workers, or employers are not laying off workers, at least right now. Then the third thing, we just got news from, it's the JOLTS survey, right? Speaking of another acronym there, it's a job openings and labor turnover survey that the Bureau of Labor Statistics puts out, right? So the JOLTS report by the BLS, right? Those are the acronyms there. But they, anyway, measure how much job openings are in the market and how many people have been laid off, how many people have quit their jobs voluntarily, things like that. We've talked about this in the past. So what the Fed chair, Jerome Powell, wants to see, he wants to see the labor market come back into balance. Right now, he's saying, there's too much demand, but there's not enough supply. The latest JOLTS numbers show that job openings have come down. So vacancies have come down, in fact, by about 1 million, right? It was at a record high. It's come down by 1 million. That's like, the best thing any of us could probably ask for, especially from the Fed's perspective. Job openings coming down, right? Which means what? Demand is coming down. But, the supply is hopefully not, we'll get numbers for employment numbers, but it seems like looking at, claims data, things like that, employment should be, fairly high. Unemployment rate should be fairly low as well. And that's, I think, great news, right? And the quits rate is going up as well. The quits matter because I think that gets into wage growth, right? Previously, I think over the last year, we've probably heard the term great resignation. Everyone's quitting their jobs. But as we've chatted before, people weren't quitting their jobs to go sit at home. They were switching jobs. And they were switching jobs for better pay, right? Better pay means more incomes, right? More incomes means more spending and more inflation, which is what we've seen. And the Fed's like, no, we want to make sure wage growth sort of eases a bit. And if quits are going down, that means less people are switching their jobs. That means the wage growth is probably going to ease up a bit, which is probably good news for inflation.
Yeah, they said that, the pandemic-induced recession was the first recession where everyone went out and bought a boat. I think you could say this might be the first recession where people quit their jobs to go make more money somewhere. So it's just interesting how that works. You mentioned acronyms. kind of got me thinking. I spent almost 2.5 hours yesterday at the DMV, given we just moved, had to get a new driver's license. It took forever. Yeah. Very nice people there. I mean, I enjoyed talking to them, but just takes forever. I had to take my daughter to get an ID. It was, anyway, I joked with her. I said, I was here for 2.5 hours. I said, I don't know how you work here all day. She's like, I don't either. But anyway, more power to the people at DMV, because it's an interesting process, but we got there. One other thing, we're literally at the end here, Sonu. I just did this and shared it on Twitter, so I'll share these numbers, and I pulled up in front of me because I want to make sure I say it correctly. So I mentioned this is the third worst start to year ever. So I looked at the 10 worst starts to year ever at the end of September. Remember, 74, 2002 were worse. 1 year after those two times, 74, you're up 32%. 2002, up 22%. The fourth worst start ever was 1962. Remember, this year is the third worst. 1 year after 1962, you're up 27%. So just kind of think about that. Some of the worst starts ever, really big gains. Sounds crazy given everything going on out there. Just know those times felt pretty dour also. Last thing I'll say on this, the next quarter, all right, I looked at the 10 worst starts year ever. So what happened in the fourth quarter? Higher 9 out of 10 times in the fourth quarter, up a median of nearly 8%. Yes, 2008 was the only time we were lower with a bad start to year down. Wow, this is crazy. So did you want to guess how much we lost in the fourth quarter of 2008? Just give me a quick number. I mean, we're at the end. How much think we lost? It was more than I thought looking at that number.
20%?
What's your guess?
20%? No, fourth quarter of October.
22.6.
Yeah. 22.6. There you go.
22.6% in the fourth quarter of 2008. So anyway, that one didn't work, but most of the other time, clearly, we had some big gains after a bad start to the year. So just some context for all you advisors out there, people that are trying to help clients understand what's going on, that there is potentially light at the end of the tunnel. Last comment on some good things. Overall market sentiment. We finally seen a big spike in put to call ratios. Last Friday, we had a record puts buying, meaning options traders were very, very bearish. Various sentiment polls showing some of the most bears we've seen since the pandemic, since early 2016. We are starting to finally see, guys, kind of the washout that's necessary. And we talked about it last week, where energy got killed, even utilities are starting to break down. They're hitting everything, right? They're hitting everything, which can be a positive sign for a major low to take place. And sure enough, here we are in the month of October, not just my birthday month, but the month of bear markets tend to end. All right, Sonu, we've hit the end of the line. What are you going to do in California that's kind of fun? Not work related, and don't tell me you drink wine. What are you going to do out there that's fun?
It's just being outside. I took a walk early this morning. It still feels early. It's about 7:30 in the morning here when we're recording this. I got a chance to walk outside. It just, I see the appeal of California, right? Of course, I lucked out because I heard a couple of weeks ago it was 120 degrees here. So I missed that, which has been, it's been really beautiful, pleasant weather. So I think the appeal is really being outdoors.
No, that sounds awesome. Have a great time out there. And guys, we're going to wrap it up. My right toe does still hurt. Maybe I'll give an update on how my toe feels next week. I'm excited because I'm going to be on a plane this time tomorrow to go to Omaha to go to the home office and check everybody out and see everyone out at the Carson headquarters in Omaha. So that should be a lot of fun. But everybody, Sonu and I will be back next week with the 5th edition of the Facts versus Feelings podcast. We'll see you then. Take care. Thank you.
Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Dietrich are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.